For our first video project, we've decided to focus on the controversy surrounding the Robinhood trading app and the GameStop stock, also referred to as GME. A saga that started catching the mainstream on January 13th, 2021, and has drastically changed the way the casual day trader views the Robinhood company and its ethics. After a Reddit user named Keith Gill posted a video on his YouTube channel, then onto the popular subreddit known as r/Wall Street Bets in late July 2020, investors began to notice a massive opportunity for profit. This opportunity was available due to multiple big-name hedge funds betting on the GameStop stock to drop below zero. These players are known as short sellers within the trading world and led to the possibility of a short squeeze phenomena to occur. A short squeeze is a large, short-term spike in the stock share price that occurs when a sizable group of short sellers is forced to close out on its positions all at once by buying shares of the stock. By January 22nd of 2021, GameStop stock price surged by 50%. By January 25th, the stock opened at $96.73, which was nearly 3 times the amount it had opened on January 13th. Yet this was only the beginning. After notable figures such as Elon Musk began tweeting out about the stock, its prices soared by nearly 140% to $354.68 on January 27th, marking a significant loss for the short sellers. This was where the saga took an unexpected turn and put the Robinhood Corporation into the national spotlight. The company restricted trading of their stock on their platform, a never-before-seen move, just as these firms announced their defeat and plans on cutting their losses by initiating the short squeeze, which led to the public to question the company's mission which it was founded on, to give the everyday citizen a chance to invest as the big firms have. Due to their poor crisis management, society began to doubt Robinhood's true intentions, stating that it was protecting the big short-selling firms with unethical behavior, as these firms were responsible for more than 50% of Robinhood's daily trade traffic. Given this backstory of information, my group mates will now dive into detail with you to display how the Robinhood board's poor decision-making led to a congressional hearing that questioned not only the company's social responsibility and legal compliance, but also the regulatory agency in place, known as the SEC, and its rules and regulations.
Hello, this is Yafei. Now I'm going to talk about Robinhood's business model and the hearing in February 2021 that questioned and criticized this company's business model due to the GameStop event. The first of the core topics in the hearing is the relationship between Robinhood and the Citadel, which is payment for order flow. In other words, Robinhood gives the stock orders to Citadel directly instead of giving these orders to exchange. Then Citadel will buy and sell as a market maker and will give part of the rebate to Robinhood. This part of the rebate is the major source of income for Robinhood, so that Robinhood can run the zero commission business model. However, this business model involves the issue of whether the best execution can be achieved for customers. The second, the T+2 delivery problem. Because of the T+2 rule, securities companies need to pay margin in the clearinghouse to ensure the smooth delivery of shares and cash in 2 days. This involves the risk of security companies during the time of transaction and delivery. If the stock price changes dramatically, the margin will increase geometrically. For Robinhood, who is dominated by retail investors, most people buy in, which leads to a surge of buying position. For the highest day, Robinhood needs to pay a security deposit of $1.4 billion, and this amount might be the total cash it owns. Therefore, Robinhood have to suspend buying of these key stocks. The third topic was regulation. Republicans on the committee were opposed to calls for new regulations on trading apps like Robinhood, or calls for reform of system of payment for order flow. Instead, they called on the Securities and Exchange Commission to reduce regulations and eliminate the accredited investor definition, which bars investors who earn less than $200,000 per year or have less than $1 million in wealth from purchasing shares of private companies. Finally, I have two questions that no one mentioned in this hearing. One is that no one judged that Robinhood's ban on buying shares was the trigger for GMA's crash from the top, and if there is anyone gain from this action. The other is AMC took the opportunity to issue twice as many shares. Does this behavior mislead investors? Given this hearing information, now my group member Will is going to talk about the unethical behavior, the ramifications that their actions had on their reputation, and more about the legal compliance. Thank you.
After Robinhood stopped allowing their users to purchase shares of GameStop as well as 12 other companies, many of the day traders were enraged by the brokerage's actions. There were over 30 lawsuits filed against them across the country. People like Brendan Nelson, the first to sue the company, stated that they had willingly, purposefully, and knowingly taken their ability to invest their money into an open stock market. Although this seemed like an illegal move on Robinhood's part, this was actually an effort by their top managers to maintain legal compliance within the stock market. It would have been illegal for Robinhood to allow purchasing of these stocks to continue without them paying the security deposit to the National Securities Clearing Corporation, so the brokerage firm had to stop these transactions immediately. Furthermore, there were a few clauses in Robinhood's terms and conditions that addressed situations like this. The first one, intended to protect newer investors from themselves, limited users from executing more than 3 day trades in a 5-day period unless the value of their portfolio is worth over $25,000. Many of the users likely did not read or understand this part of the terms and conditions. The second clause stated that the broker has the right and sole discretion to restrict, cancel, block, or delete users' accounts from their app. They also have an arbitration clause that makes it much harder for either the broker or the user to file lawsuits against one another in a court of law. Because the users accepted the terms and conditions in order to use the app, these claims are very unlikely to hold up in court. It was very smart of Robinhood's top management to have written this into the terms and conditions for situations of crisis management like this one. Although the brokerage firm's actions weren't illegal, the majority of people viewed Robinhood's actions as unethical behavior for the company. Because most of its revenue comes from market makers like Citadel, their loyalty lies with them instead of their users, which opposes their mission to democratize finance for all. This contradiction caused many people to become angry at Robinhood and question their true intentions. This has led to many entrepreneurs trying to come up with a business plan that works better than Robinhood's. To recap, the GameStop controversy has drastically changed the way that brokerage firms like Robinhood have to operate. The short squeeze brought the company's actions all the way up to Congress, where Robinhood's relationship with market makers, their use of the T+2 rule, and the use of regulation on their platform were discussed by the nation's leaders. As the legality and the ethics of the situation came under scrutiny, top managers at Robinhood had to make tough decisions in order to protect their company and its image, which in turn hurt their reputation. This situation will continue to be studied, and Robinhood's approach to democratize finance for all will keep changing as the situation continues to come to light.